Hey, podcast world. Welcome to another edition of FNO InsureTech. This is one of those times where I am here all by myself because my cohorts, my partners in crime, are out on vacation enjoying the world at large while I'm sitting here strapped to my desk, getting it done one day at a time. On today's exciting episode, we move back into the corporate venture capital world with a guest who I am so excited to have because he's really, though very humble guy, one of the honest to goodness leaders and superstars in the corporate venture capital world. And that's Dan Reed, managing director at AmFam Ventures or American Family Ventures out of Madison, Wisconsin. Dan had a really interesting path to where he got to and where he is today. AmFam Ventures was founded, I think, in 2013. So, in the insurance carrier supported CVC world, that's makes them kind of an old timer of sorts, or towards that end. And you'll hear that reflected in our interview today, that he has a lot of knowledge and know-how and insight that he's gained through being involved in many important acquisitions over time and some remarkable exits. The leader of that is probably the exit that you've heard about, is the Ring, which you may have at your very front door. And AmFam Ventures was an early investor in that rocket and saw it all the way through to the end. But they're also invested in many other names that you may know, including Hover, who's a company that we use all the time in our work and in our process at Fourseventy. And they had the insight to see that. But in our interview, we'll talk about what it means to do this work, how do you do it, and the challenges thereof. So without further ado, and all by myself, let's get to our interview with Dan Reed, Managing Director at AmFam Ventures. Hey, everybody. Thank you again for being with us today. We have Dan Reed with us, who's the Managing Director. Is that right? At American Family Ventures?
That's right.
What does that mean, Managing Director?
It means I both manage and direct.
Two roles.
It is right. It essentially means that it just reflects the fact that I was here at the start, and I've been leading the team ever since we got organized in 2013.
Cool. So, American Family Ventures, also known as AmFam Ventures, correct?
Correct.
Can you give us a couple of minutes on what the heck that is and how it came to be and what you guys do?
Sure. We are the direct venture capital group at American Family Insurance. And what we do is, for the past 7 years now, we invest in early stage startups that are in and around the insurance industry. So typically we invest maybe $500,000 to about $3 million into companies at the seed through Series B stage. And we then try to help them along their growth path as best we can.
We'll get into some of the details behind that and the inner workings, but is this to help American Family Insurance strategically and tactically, or is this just an investment play? Where do you guys break that up?
Yeah, well, that's one of the things that's really changed over the years. When we started back in, I guess, 2013, the premise that we had was that we would seek investments that had financial potential. And by financial potential at the early stage startup level, what we're talking about is there's some plausible path to make 10 times our investment over the course of 5 to 7 years. And so we would start with that, but then we would focus our activities on things that we thought had some sort of strategic relevance to either American Family Insurance or more broadly to the insurance industry as a whole. And the way that we would articulate that dual mandate was that every deal that we did, when we wrote that first check, we believed it was was checking both boxes, or the way we
Mm-hmm.
actually laid it out, because I'm an ex-consultant, was in a 2x2 matrix. And so on one axis was the financial potential, and the other was the sort of strategic optionality that it might provide. And when we would write the check, we believed that every time we did so, we were doing so into an opportunity that was in that top right quadrant that met both characteristics. And part of that story and part of the rationale for doing this was, and this is a common way of thinking from a strategic investment point of view, is it'd be great if the companies, as they developed, if they stayed in that dual benefit type scenario. But and some have over the years, but
Uh-huh.
it's also fine if maybe the strategic aspect doesn't really pan out, but we have a financial return, and it's certainly okay to make money as an investor. Uh, but then from the other side of it, maybe the market might not reward what it is that the startup does over time, but it provides some benefit to the organization that's well worth the price of admission. And when we started, there were three of four of those quadrants where we felt like we could have a benefit. And then there was the one where you don't make money on the investment and you don't really maybe take
Right.
advantage of the
Right.
strategy. Interestingly, I was very sensitive in those early days to set the expectation that we're going to have some that end up there.
Sure.
That's just the nature of the asset
The
class.
law of averages.
Yeah, but it's actually important to have some that end up there, because if you don't, then it's possible that you're not taking enough risk. You're not being aggressive enough with this small allocation of capital relative to the overall size of the company. And when I would talk about that, I'd get a lot of nodding heads. And then we had a couple that landed in that quadrant,
Uh-huh.
and I kept coming into work, and they didn't take away my badge, and so it was all good.
You were still managing and directing.
That's right, yeah.
Yeah.
So over time, though, I mean, and I think that's a very standard way to think about investing from a corporate platform. Is you're seeking both opportunities, and I've heard it described by other investors as, that dual nature of what you're trying to do, at least on the surface, leads to behavior like corporate investors bidding up the prices of certain financing rounds because they can capture some value from the strategic side. As it's played out for me, I don't. That's certainly not a conscious decision that we make, and I don't know if anyone makes that decision consciously. And in fact, the way that we think about the strategic side of what it is that we do relative to the financial side has evolved fairly considerably over the years. Now, the way that we tell the story is not so much with the quadrants, which, although there is a certain elegance to the framework, I think, but we talk about how every investor, in order to get returns that outperform the peer set, however you define it. In our case, we define it as all early stage venture capital. You have to have a few things going for you. I mean, the first thing you have to be able to do is to be able to source and make a case for yourself to attractive investment opportunities that you're the
Right.
right investor
Yeah,
for,
because you're
for that
certainly not
company.
the only one out there.
No, so they talk about it in the venture world. This sometimes you have to sell your money,
Sure.
which is an odd concept, but a real one. Uh, the other thing you have to be able to do is, once you have a certain set of opportunities, enough deal flow, you have to make informed decisions. You have to be smart money. And the knock on corporate investors historically is that they may be smart on their category, but they're prone to sort of rookie mistakes when it comes to venture investing. Um, but for us, investing in spaces where we have the opportunity to be smart investors, by bringing some industry knowledge and some experience gained over the years now, is key to the strategy. And then the last thing is, every venture investor, this is like a venture cliche playbook 101, is they talk about it. Well, it's not, we don't just bring capital to the table. We bring a whole bunch of valuable additions to your company at the various life
Sure.
cycles that it will go through, whether it's helping source talent, or helping you navigate an
Relationships.
industry, or helping relationships, essentially, right? Or and certain
Mm-hmm.
know-how
Mm-hmm.
about what it's going to take to grow the business. And I think all of those three things, whether it's sourcing or evaluation or value add post investment, they lend themselves to having a strategic focus. They lend themselves, and by strategic focus, I don't mean coming from an industry perspective necessarily. I just mean having a knowledge base and having some expertise in the areas where you where you intend to invest. And it happens that the focus areas that we've chosen and chosen to become good at them, they happen to matter to the insurance industry. They happen to matter to our source of capital, which is currently just American Family Insurance. But they're not at odds with financial returns. And in fact, I think they enhance the potential for financial returns in the same way that any expertise or any focus would for any venture capital investor.
Cool. Interesting. So, so let's take a second and just go back and talk about how you got here. I mean, full disclosure, I'm a major baseball fan, big time,
Oh.
and but I did have to look you up. I wasn't familiar with the Dan Reed career.
Yeah. Well, that's a funny story, actually. When I met my wife 12 years ago. So what you're getting at is that I had a minor league baseball career. I played baseball in college, and I played in the minor leagues for the Baltimore Orioles. And but my name is pretty generic. And in fact, I think it's a Canadian rock star from the 90s, maybe, or maybe I think he's still active. I don't know if he's just from the 90s, but when my wife and I were introduced, it was a blind date, and I was able to find her pretty easily because her name is Kelda.
Yeah.
And there was not that many Keldas in the world, so it was an easy Google stalking situation for me. But she looked up Dan Reed, and she found like 15 pages of results for the Dan Reed network, and then she tried Dan Reed baseball, and she couldn't even find it there. But somewhere on there, there's some medium level minor league statistics on my old pitching days.
I have a question for you to kind of bring it back to the bigger point that we're talking about today. What about your baseball experience helps you today? What did you learn from baseball that helps you today?
Oh, I guess there are a couple things. It's funny, I never get asked this question, so I don't have a canned response on it. The two things that come to mind immediately, though, the first is that what I really value in the team that we have here, and just generally in teams in any context, is the sort of shared spirit of mission, where everyone has a certain role to play, and it's moving a little bit too cliche to say we all play a certain position on the team. But there are certain relative strengths that people have, and you see them play out in the team setting. And the culture that we've been lucky to have here at American Family Ventures, it feels a lot like a sports team. It feels like we are all pretty clear on what winning looks like, and we all know the role that we have to play within it. In my case, as mentioned, it's both managing and directing. But then the other thing that I think about from the baseball days, and this goes back to, this makes me think a little bit of Tiger Woods, is just the sort of power of real driven intention. Mm-hmm. I remember when I was playing in college, that team aspect was prevalent. I had the chance to play at Stanford, and we went to the College World Series.
Cool.
And at one point, we were ranked number one in the country, and everyone had the same goal, which was get to Omaha and play in the College World Series. And we didn't end up winning it, but we did get there. And people would just drive themselves toward that intention to the point where, if you win or lose a game as a pitcher, it would take me a couple of days to shake it off. You'd end up running the stadium stairs. You'd do whatever you could to get a little bit better, both out of an accountability to yourself, but also to your team. I got to the minor leagues, and you're playing so many games. I think the college season is something like 50, 60 games. But the minor league season is 140, 145 games. And after a couple of years, I won't say I was okay with losing, but I was a little bit more mentally balanced when it came to the sort of ups and downs of mm-hmm. professional sports. It was like I expected to win, and I was happy when I won, but it was sort of expected. And when I didn't come out on top, it didn't have the same sort of catastrophic feel to it. And as a result, I kind of reverted to the mean, and I ended up ending my career by they sat me down in the locker room in spring training and told me, "Here's $200, and this should get you back to wherever you're from, wherever that is, and off you go."
I'm thinking of the scene from Bull Durham where he brings the kid into his office and he lets him go.
Yeah,
You lived that.
yeah, I did, and I remember I actually played in the league where Bull Durham was filmed. It was the Carolina League at the time, and yeah, my experience with being let go was it forever etched in my memory. It was three of the Orioles staff members, and they sat me. And maybe it was intentionally a sort of 3-on-1 type thing because you never know what someone's going to do. But they said, "You went to college, right?" And I was like, "Yeah, of course. You drafted me out of college." Like, I said, "Okay, well, yeah, you had a pretty good run. So what are you going to do now?" And like it's one of those moments where 50 things go through your head at the same time. Probably 5 things go through your head at the same time, ranging from, I think what I actually said was, "Well, I guess I'm going to have to go get a job." I mean, I'm in here in spring training in a Baltimore Orioles uniform. I didn't really have major backup plans. I think they thought they were being considered, but actually it was almost taunting the way that
terrible.
they did it. So yeah. So that was it. I guess the point I was talking about, I mentioned Tiger Woods. I don't want to leave that dangling out there, right? That's one of the things I've always admired about him is he seemed to really care long after he logically should have. You know, he made so much money so early in his career, but he was still driven by that desire to win. I think that's really key, and I think tying it back to how does it play out with venture capital or startups? I mean, I think that all of the things people say about the startup culture and the sort of respecting the hustle, and you don't really know what it's like until you've done it. I think that stuff is true, and I think you have to have that same level of drive and mission and sort of relentlessness that in order to make a startup successful over the many ups and downs that you can have, that you do to maintain an athletic career.
And, you're going to win and you're going to lose. You just want to win. You just need to win more than you lose.
Yeah, and you never really know what the competition is doing, and so you always maintain this edge that I think is it's quite productive for the pursuit of a goal. It's probably not super healthy over the long term to the maintenance of a sort of healthy spirit, I guess. But as long as you can sustain it, it does pay off.
Well, that's interesting that you bring up the competition. I wasn't going to even particularly ask about this, but the person that introduced us was Joe Kurgis at from On-Ramp and Generator. Great guy.
Joe's one of my good friends.
He's been on our podcast and very, very generous man. And he's created an environment where the CVC, he's almost helping to create a CVC community, right? And you guys get together and you talk and you share. We had Ted Stuckey on. You probably know Ted.
Sure.
So is there a competition? I mean, or is the marketplace just so vast that it's kind of easy to get there first with some of these companies?
Yeah, so I guess it's natural to think about the other corporate venture investors in the insurance space as the competition. I don't really think of it that way anymore, which is reflective of another bit of an evolution that we've gone through here at American Family Ventures. And it brings me back to sort of the concept of doing venture capital wrong. And maybe doing it wrong from a corporate point of view. The first deal we ever did, we thought we were being very clever. We loaded the deal with a bunch of these so-called strategic terms, where we had an exclusivity provision. We had the right of first refusal if the company were ever sold. I mean, this was a company that was going to help agents get onto social media in a compliant way, and I think it's very natural to approach deals in the early days from that
Mm-hmm.
kind of corporate lens. Uh, but what we ended up doing, and in hindsight, we were kind of lucky that it played out this way, I guess, because it taught, well, only in the sense that it taught us a lesson the hard way, but it was sort of early in our process. The company started to develop uh, solutions that were outside of the insurance industry. They I won't say they abandoned the insurance industry as a development priority, but they deprioritized it, and we couldn't figure out why until it dawned on us that we had, through our clever contract, we had taken an entire
Right.
industry off the table for them, and so of course they had deprioritized it, right? And the solution wasn't so great for our agents anymore. We ended up switching partners on the operating side, which was a hard lesson to learn, but a valuable one, like I said. And to me, that lesson, it led to a whole bunch of rethinking about how we were going to approach so-called competition. Um, to the point where a couple of years later, we made the conscious decision that not only are we going to not exclude competitive, insurance carrier VC groups from certain deals, whether we're leading or participating. We were going to welcome it, and in some cases, we were going to seek them out and actually
Interesting.
bring them in because they offered something. Yeah, they offered something that we didn't, or the company itself would benefit from having. Um, they were sort of deep in insurance or wanted to sell to the insurance market, and we wanted to make sure they had full leeway to do so. And so we, not only did we get rid of that kind of exclusivity mindset after that one deal, but we almost overcorrected in the other direction, and we started creating these syndicates of insurance carrier VCs, and that's lent itself to kind of our next step, which is what we're actually uh, we're formalizing that, and we're bringing in a number of other carriers into a new capital vehicle that expands our work beyond just American Family.
Really, that's so interesting. In hopes of leveraging expertise from a variety of very interested parties.
Yeah, that's exactly right. Going back to the kind of how we think about strategy and financial returns, it's going to allow us to, I think, tell a differentiated story about the syndicate that we're putting
Hmm.
together, to the market, and hopefully help position us as someone that you really should talk to if you're raising money around the insurance industry. It helps us get
Hmm.
smarter about the deals that we're going to do because there's more voices and experience uh, uh, that we can draw from, of course, having a syndicate of parties that are seeking this kind of partnership with innovative startups will only help us deliver value to the startups once we make that investment.
Does does the fact that you've had success with some of your with many of your investments, does that help you make you more attractive to the startup community? Is that important to them?
I I think it is because at least that's the story I tell myself. I think when you're a startup and you're making the case that someone should invest in you, you're looking to offer as many proof points as you can, and those proof points come in subtle and not so subtle ways. And the obvious one is, what's your sales traction look like,
Hmm.
and what's your growth rate look like,
Hmm.
and the not so subtle ones are, how well does the team work together. How insightful are they about their own operating strategy? And I think having some track record of success on delivering financial returns through this investment vehicle, and delivering the kind of operating partnerships that the startups are seeking from an investor like us, that does help us make the case for why we're the right investor for the opportunities that we're most bullish about.
One of the reasons I ask is my son is involved. He's a founder in a startup, not in the insurance industry. They're providing SMS solutions to the retail industry, and it's super interesting spaces. I'm sure
Okay.
you're probably familiar with it. And they went through Y Combinator. They were accepted in Y Combinator. They went through Y Combinator, and at the end, as all the various and sundry venture capitalists come along and pitch them on investing in their company if they believe in it. And there was an enormous crowd of VCs who were interested in taking a position in their company. And it was really quite taxing on my son and his co-founders how to decide who to use. It's an
Right.
interesting thing. I'm interested in that part of the process and how you work with that.
Well, I mean, that first of all, that's a great situation for your son to be in. That's the sort of like definition of a good problem, right? Um, I think there's a handful of real marquee brands in the venture capital space. The ones that people with just a passing interest in startups and entrepreneurship might know by name. Uh, and I think it's nice to be in that position because they benefit from the brand that they've built over dozens or more years. If you're in that sort of not startup household name category, then I think your son's probably going through or went through a certain calculus around what is it that what even are the factors again on which I should compare these opportunities. Should I be looking at the deal terms? Should I be looking at the
Right.
sort of off the paper benefits that I get from these different investors, and it can be tough to I
Mm-hmm.
suppose it can be tough to parse out. From our point of view, we just want to be in the conversation, and that's the sort of first objective is find a company like that and get them to hear our story about what it is that we can do.
Is that what it was like with Hover?
Um, you know, I think the situation with Hover. So Hover, you're mentioning is one of our portfolio companies. We invested in, I believe it was 2016, into Hover. They do something that's um, something that we really like as a strategy, which is they have the insurance market as a core vertical, but it's not the first one. Um, they had built a business on in another industry. It was window and siding contractors, and what Hover does for those of you who or haven't followed them that closely is it's a smartphone application where you take photos of the exterior of a home, and using some machine learning, Hover stitches it together into an accurate 3D rendering of that home. And the applications for window and siding are more on the sales side. You
Mm-hmm.
can do a
Mm-hmm.
quick bid, but then as they started to expand into the insurance industry, we saw the application for claims adjusting and for underwriting as quite attractive, as I'm sure you did as well, in managing the cost of adjusting an exterior claim in particular.
Correct. Correct.
Yeah, and so for us, I don't remember the exact dynamics of the round that they were putting together, but I do
Mm-hmm.
remember thinking that this is a great example of one that has independent financial potential, um, both in terms of really the quality of the solution that they provide, but also in terms of they're building machine learning off of a proprietary imagery that there just aren't training data sets of the exterior of every U.S. home. And so they have some defensibility in
Mm-hmm.
their narrative as well. And then the strategic implications for how our company or how the industry could derive a benefit from their solution were fairly clear to us as well. And we love the team. We liked the
Mm-hmm.
time at which we caught them, and we've been very pleased with the investment ever since.
Yeah, our experience with them now is we've been using Hover for over a year and in the field, and have had good success with it. In fact, one of the carriers that we do business with requires it as part of every claim file, which is an interesting choice that they make. But it's a great product. I think it's it was obviously insightful of you guys to get behind that. But it sounds like you helped them develop some things strategically. Yes, that you saw some potential in it.
I really hesitate to take any credit for work that they did. And I don't think it would be I don't think I'm being falsely modest in saying that. I think that every time that we talk, they make more and more progress on the technical side and on the business side.
Uh-huh.
And, the role that we've played with them is sort of an early insurance voice. But they've progressed within the insurance market well beyond anything that we've told them.
Mm-hmm. Yeah, the progress we hear about them frequently, not from Hover and the people we know there, but from others in the industry and on the carrier side who are either looking at them seriously or using them. So I think that was a great thing. Can you let's talk for a second about the process, just quickly. How do you get from somebody that you've never heard of, a company that you've never heard of, to investing? What are the steps involved there? And I mean, how do you even start? One of the things that we've learned, I mentioned this to you earlier, is that there's a vast landscape of insurtech companies out there. How do you sort through it? And then once you do, how do you get to investment?
Yeah. So how do you sort through it? We're a team of 12, and one of the goals that we've set for ourselves is to never read about an insurance related or something within our scope. Never read about a financing that we weren't already aware of. And that's an ambitious goal because it is a booming space. But we do that through developing some personal network by doing the things that we ask our portfolio partners to do, which is just wake up thinking about this and hustle as much as we can over the course of the day. Um, how we make a decision probably is best sort of moving backwards from the end of the process back to more of the start. The way that the process ends is we have an investment committee. It's common to most investment groups, um, and where we have a vote of the more senior members of our group. And it's the way the voting actually works is we have to have a majority of the principals on the team vote yes on the deal, and then I have to vote yes on the deal, and then we sort of move it through the legal process to get the deal executed. Prior to that investment committee discussion, we will have likely had 2 or 3 uh, discussions at our Monday meeting about the company, as someone is leading the investigation, leading the relationship, and kind of working their way through their own question list. And what they'll do is they'll bring their findings and their sort of in progress thinking about the possibility of working together to the rest of the team. We meet every Monday, and we go through sort of what's the funnel look like and what's happening within the portfolio, and if there are other operational things that we need to discuss, we'll discuss it there. But Mondays they tend to be the favorite meetings of the week for most of the team, because you have this pretty lively discussion about uh, what do we need to believe in order to make this deal, and how strongly do we feel about uh, the support that we can make, or the facts that we can provide to make us believe what we would need to believe. Um, that process for us has been a bit of an evolution. It used to be that we would someone would work up a deal kind of independently for days, or more likely weeks, uh, and then sort of bring a fully formed recommendation to the rest of the group
Mm-hmm.
for consideration. And what we found is it's just too much to it, it's almost too much to take on as a decision maker to try to ingest a 20-page memo
Right.
on a team that you don't have familiarity, and do it live,
Right.
and do so in a decision-making framework. And so the way it's evolved has been the deals that get done. They tend to have informally involved some thought partnership from the rest of the people on the team, particularly those who have a specific say in whether we do the deal or not. And that kind of informal thought partnership has lent itself to some cohesion among the team, and I think better decisions along the way. Um, we end up with a lot of deals. I mean, this is something sort of around uh, around this venture capital decision making table that I don't think is at all unique to us. but it's one that I don't think entrepreneurs have a lot of visibility into, is um, the sort of gray areas. It's not a clear no. It's not a clear yes. We like the deal. There's certain aspects that we're very excited about, but there's others that it's not that we don't like it. It's that maybe the evidence isn't there, or we're not comfortable with that component of the sort of multivariate equation, which is too fancy a term here. The sort of,
Well,
yeah,
but
and we
the gray ones are harder.
they're harder, and we end up in this. It's not a yes, it's not a no,
Hmm.
and the thing that I always find. Um, it just doesn't feel right when we do it, but it actually is the right thing to do in a way, at least from our perspective, is we give a sort of not right now answer.
Hmm.
It isn't the right time, or,
Hmm.
we need to see more traction, or this and that. And that I think from a founder's perspective, that feels incomplete. It feels like like the VC is preserving the option for themselves and not sort of releasing them in the
Sure.
wild in the right way. But really, I think at least in my case, it's intended to be respectful. It's intended to be. We're not passing judgment necessarily on your company. It's just not something that we're prepared to fund right now.
Well, I'm sensing that like you used the word believe a minute ago. Belief. Like you have to believe in these things. That there's a gut involved in this. It's not just what the equations say, right? Or
Yeah,
is that true?
that's it is, and you've hit on something that we've had discussions with. Uh, I think I'm at odds with the rest of my team about this, but I don't have a better way to think about it. Is I don't like when the team uses the term conviction about I have real conviction about this, um, because to me you can have conviction and be completely wrong. Conviction feels
Ye-
it's like
Yes, that's true.
you know
There's a lot of history on that.
yeah, right. It has the essence of a feeling. I feel very strongly about this deal, and I want to at least I want to try to take emotions out of it as best we can. But I don't know that it's possible, and like I said, I don't have a counter proposal that's better than conviction. It's I think what team members who've been successful in their argument around this to me have noted is that my conviction is not just an emotional thing. Like I can have conviction and get there in a very rational way.
Yes.
But there is that connotation that conviction had, to me at least, that conviction is born out of I'm just convinced. I really want to do this deal, and I feel very strongly about it. Therefore, we should do it. And I don't really care how strongly you feel about it. I care about it. How much uncertainty we can take out of this thing and out of
Hmm.
this decision. And the problem
Hmm.
is early stage venture. You can't take a ton of uncertainty out of it. That's just the
Correct.
nature of the asset.
Correct. I bet that leads to some very lively conversation. But what you're trying to do is you're trying to keep it as systematic and and unemotional as you can.
I think so. I mean, we're all subject to a long list of well-known cognitive biases, and it's good, I think, to step back from time to time and try to examine how they might be affecting your advocacy of a particular deal. It reminds me. I used to be a I might have mentioned this after grad school. I was a management consultant with Boston Consulting Group, and I remember I was working on an engagement with a client for must have been 4 or 5 months. I was spending a lot of time with this company, and with the people who were leading at this sort of mid level of the organization, and helping them, or they were helping me think through a particular challenge that they were having. And I remember the senior partner from BCG came to review my work in anticipation of presenting it to the more senior leadership of the company. And he looked at it for 5 minutes and he said, "Well, you must be too emotionally invested in this company." And I was like, what are you talking about? How can you say that to me? I've been here for, it was like your conclusions are wrong. And it must be because you've sort of lost your perspective on this.
Sure.
And I thought, how can you look at what I did for 5 minutes? I've been here for months and tell me that I must be too emotionally invested. Like, what if I'm actually right? And you have no idea what you're talking about. And, and in hindsight, I can't remember the exact situation, but I'd be willing to bet that if I looked at it now, I would say he was probably right. But whatever.
He was right.
Yeah, he was probably right, but he was kind of a jerk about it.
Let's talk about exiting. Why do you exit? And you must have determined things you're looking for in an exit, and what dictates the right time for an exit? Tell me about that.
So we've had 13 of our partner companies actually 12 have been acquired and one went public. So we have some experience with this, and to your question, what makes the right time? The sort of, I don't know, cheeky answer is it becomes available to you. I mean, when you get an attractive offer, as I mentioned, 12 of them have been acquisitions. You to deliberate on it as a board, and if we're on the board, which is about half the time, and then you look at things like what's it gonna what do we have to believe about this business in order for us to it's kind of like you re-underwrite the company in a way. It's you sit there and you think like what would have to happen for us to exceed this outcome from that financial point of view, and how do we feel about the probability of us achieving that, and how much more capital is it going to take to get there. I mean, you basically just sort of you make a calculation about, is this the right time to do it? And every situation is a little bit different, but the process is pretty much always the same. And I don't think I've been in a situation where there's been any sort of split vote. It always just sort of one thing that does happen, I mean, to try to say something that isn't totally obvious, is one thing that does happen is, because we're focused on early stage startups, the typical path for an early stage startup is to be what people call default dead, which is you're going to need to raise another round of capital in order to keep the business going, because you're biased toward growing the top line rather than the bottom line, because at the early stage, the typical valuation methodology is a multiple on revenue, and the faster the revenue growth rate, the oftentimes the larger that multiple will be. But that leads to a situation where you occasionally have to sort of pull your head up and say, okay, so are we going to be able to raise the next round? And if so, are we going to be able to do it at with terms that we can be comfortable with, or is now the right time to start to introduce the possibility of some optionality into that decision? And the optionality will often look like a founder conducting a fundraising process at the same time that they're having a limited number of kind of strategic acquisition conversation. And the best situation is when you end up, it definitely is a real challenge to pull off. But when you have a situation where you have multiple acquisition offers is ideal. Sometimes you can have multiple acquisition offers and some fundraising options. And I think the one, it's happened once in our portfolio. It was kind of fun to see. It was a company that had achieved this cash flow break even status. So they didn't actually need to raise money, but they had the opportunity to raise money and they had the opportunity to sell. So they really had three choices as to what do they do next with the company. And that was a much more comfortable place to be.
but it doesn't usually play out that way.
No, the way it plays out often is, I mean, that's the sort of happy side of it. Mm-hmm. The other way it often plays out is, and this is one of the things I mentioned about Hover. Is one of the things we liked is the insurance industry was kind of a secondary market for them, and which we liked about it because the insurance industry has a really long sales cycle. And you can just run out of gas waiting to get your customers closed.
Don't I know?
Yeah, right. And and so you have that. You have you end up in that situation with some frequency where the company's fine. The product is coming along nicely, but the sales traction isn't where you'd like it to be. And in order to feel confident about raising the next round, and then you're looking at less fantastic outcomes, but still worthwhile to keep things going and um, and to find the right home for the business. And we've had that happen a couple of times within our portfolio as well, and it's not a bad outcome. Um,
Hmm.
it's just all sort of part of the spectrum of outcomes that happens when you're trying to grow something quickly.
One of your more famous exits uh, and recent is Ring.
Yeah, yeah. Ring was a really fun story to watch. We got involved with Ring in what's probably a predictable way, but it felt new to us. Where you do one investment in a space and you learn something about the space, and then that leads to a couple more, and that leads to it's like the opportunities start to present themselves once you're active within a space, and you get a little smarter about it. And by the time we met Ring, I think we had made maybe 12 or 13 home automation investments, including running a home automation accelerator with Microsoft at their corporate headquarters in 2014. So we felt very well, and we'd run a whole bunch of policyholder tests with some of these partnerships. So we felt very well tuned up on what makes for a compelling home automation opportunity, and maybe sort of consumer IoT in general. And we met Ring at a time when uh, they were doing about $200,000 in sales a month, uh, and we settled on a price together. And by the time we actually closed the deal, we got everything through legal. I think the Christmas season had hit or something, and they had grown their sales to $2 million a month. And what I
Oh my gosh!
yeah, it was amazing
Wow!
over the course of just a couple of months. And they
Wow! Okay,
what I really found endearing was that they honored the terms of the deal, and
that is endearing.
it was great. And we ended up what felt like a fantastic bargain from the start. And then that was really just the beginning of the relationship. We put together a partnership with them around uh, subsidized offering to American family policyholders with a discount on home insurance, with a discount on the device, with a deductible reimbursement plan. It was all pretty cool. We rolled that out in the first year that we were working together, but you know, very quickly the company just kept growing and growing. And every time we would catch up with Jamie, the founder, he would tell us another. It was just delightful, from an investor point of view. He'd tell us another story about, oh yeah, remember I was telling you it was $2 million a month? It's $8 million now, and like, oh my goodness. Uh, we'd be at a lunch here in Madison, Wisconsin. I'd look over my colleague's shoulder, and there's Jamie on TV with some of his first TV ads, and we're taking selfies of that's our guy, and that's probably some of our money that's
Right,
that's
right.
being buying the TV ad. Richard Branson came in, Kleiner Perkins, and Goldman Sachs, and it just kept growing until Amazon bought them. And it's a very lucky situation to be in, um, and I've read somewhere that every venture capitalist that's made a career in venture capital has had something like that, some sort of lucky break in the first few years that allows them to keep doing it. And I feel very fortunate that we met them.
Sure. And in the interest of time, we won't go into it, but I'm sure that you have experiences that are at the other end of that spectrum as well, which are inevitable.
Sure. Yeah. We're back to that sort of initial framework that we thought about on the financial and strategic side. We've had some that that the market didn't develop the way that they expected it to, and the investment didn't plan out. We've had some where, and I hate to admit it, but I'm not afraid to, because it's been a learning process for us along the way. Is where our sort of value add didn't pay out the way that didn't sort of play out the way that we thought it would, and that's been embarrassing. I mean, there was one early situation where it took 16 months of sort of operating negotiations with some of our partners to get to an answer of no to one of our startup partners, and that wasn't good. And so you learn from
Sure.
that, and you try to develop better systems and better ways to deliver against the expectations of your partners. And hopefully win more than you lose.
I want to touch on what you guys did with Ring on the marketing side and ask you if you're doing that with other stuff. I love the idea of working these investments on the marketing side for American Family. I mean, obviously they have operational impact in certain areas, particularly, the AI and machine learning stuff that's out there and the telematics stuff. And you guys it seems like you're pretty well invested in that. But have you had other opportunities on the marketing side beside Ring?
Yeah. So we've had, I think the count is 56 portfolio companies at this point, and 32 of them have had some sort of operating partnership with American Family or our affiliates.
That's
And
terrific.
yeah, it's been, and those range from small, initial programs to, in one case, American Family ended up acquiring the whole company, and it became part of the team that's managing a digital transformation office within the organization, which is great to see. So, I mean, I think it's part of the value proposition that we sell ourselves on to the market, both to other investors and also to the startups, that we do really whatever we can to help them grow. Um, and that, really, obviously, it starts with our own colleagues at American Family, but it doesn't really end there. I mean, we've had a lot of our companies. However, is a good example that will help them meet other carriers within the industry. And then I guess the other thing is, from the and we look at nearly 2,000 companies a year for investment. And
Wow.
for every deal that we actually do, there's probably 10 that will make introductions into the operating areas of the business. So it's we see if we can add value to the startup in some way, even if we don't make that investment. And oftentimes, uh, there's an opportunity for partnership outside of the equity vehicle that we have here.
I want to close by asking you a question about InsureTech, the phenomena. One of my friends who's a, a really, really smart guy in the insurance industry, he works on the claims end, said that he feels that that there's an InsureTech bubble, that there's just too many uh, uh, running in too many different directions, that he doesn't see how it's going to do anything but pop. And as somebody who works in it every day and is deeply vested in the movement, I'll call it, how do you feel about that? How do you look at? Are you concerned about that?
I've gone through a few different phases of thinking about that. And like you, I think we were in the space before it was called InsureTech, and for it was just called insurance, right? And
Right,
uh,
right.
and we sort of bristled at the naming of InsureTech, and for a couple of we saw it pop up in maybe 2015, and for a couple of years we were really reluctant to use it. It was like, no, we were here first, we were here early. We're too cool to use the term InsureTech. We just go with insurance, but it's so overwhelming. Then you go through,
uh,
like, is it spelled with an e or is it not, right? But it's so overwhelming. It's so ubiquitous that you can't help but use it, right? Um, I'd say that for us, both the name and the sort of boom happened in 2015. And it was really in the second quarter of 2015 when, if you look at the venture funding into insurance related startups, there's this huge bolus of funding into three
Benefits.
deals in,
Right,
in Q2
right.
of 2015. And one of them was Zenefits, which raised $500,000.
Yes.
Yeah. And they have, quite a story after that. But almost almost overnight, in hindsight, we saw the nature of the pitches that we were receiving in our insurance, focus area, really changed dramatically. Prior to the a lot of the press and a lot of the hype around Zenefits, the deals that we would see within insurance were almost entirely geared toward making legacy carriers more efficient in their operations. And after Zenefits, we started seeing more and more pitches that were taking the industry on as a competitor rather than a efficiency aid. We
That's
started seeing
interesting.
pitches like, yeah, did you know that the insurance market's a $5 trillion market and it's old and fat and slow, and they still use fax machines, and like all this kind of stuff that was upstart type language, right? And I think a handful of companies like that have really risen to prominence, both in the trade press, but in the popular press around uh, the idea of modernizing this sort of end to end of how a carrier works. But at the same time, we still see a lot of the I think in the wake of that, we see an increase now. I characterize it as like an overnight shift toward this sort of disruptive messaging, but I think in the wake of the disruptive messaging and the money that's been going into that, we see more and more of companies that are focused on process improvement or efficiency gain. So I don't know. I mean, I think it's easy to say that the handful of high flying MGAs or carriers that are out there are overpriced, but what do I know? I mean, time will tell,
Right.
and I could argue both sides of it pretty strenuously. I mean, the the sort of legacy carrier perspective that growing an insurance business is going to take a ton of capital, and it's hard to do is valid. And the startup perspective, and I feel like I've got one foot in both of these camps. The startup perspective about being lean from the start, sort of being 18 years old again, and maintaining a fitness regimen, it's going to lead to long-term competitiveness in ways that are obvious now, and around customer experience and expense management, and ways that aren't obvious yet
Hmm.
around the sort of nimble product development and others. And who's to say what's really going to happen? It's going to take a lot of money, and so the concept of a bubble, yeah, I don't know, but I think that there's a lot of opportunity in the space. And as I go around talking to carriers who are looking to get more involved, there's a lot of players who haven't really even started to engage yet. And uh, so
Correct.
I like the space a lot. Obviously, we're still investing in it, and I see a long future for it.
It just seems to me that, like you were saying about the nature of the insurance industry relative to, say, other industries that are out there today, there's a lot of opportunity, and that's indisputable. There's a lot of efficiency opportunity and growth opportunity and distribution opportunity. The list goes on, and so if you can get there fast enough, um, I think that there's just big opportunities out there.
Yeah, someone described it to me. A founder recently. He says that there's just inches everywhere. You can take inches out of it everywhere you look, and
Wow,
and if you
I like that.
if you don't start with those inches, then you set yourself up well.
Hmm. Hmm. Well, listen, I am so grateful I've kept you longer than I said I would, but that just speaks to how intriguing you were.
Well, thanks a lot. I appreciate it. Yeah, I just looked at my watch. But I enjoyed the conversation, and yeah, hope to talk to you soon.
Well, we appreciate having you on today, and have a great vacation.
Thanks a lot. Thanks. I really appreciate it.
Sure. When I get to do podcasts by myself, it's actually a little easier because I get to take it wherever my mind wants to. And this was a great example today of having one of the real serious experts in the CVC field, one of the most experienced and most successful CVCs out there in the insurance space, to be able to chat with and answer questions. And Dan had so many great insights and ideas to share. And just so you know, a very generous guy, and a very nice guy. I really loved what he said about their Monday meetings and what it's like to go through and vet these companies and work from, like he said, they look at, I think he said 2,000 companies that they look at in a year, and to get down to that small number of ones that are actually going to get their investment is a challenging process, but one that they've figured out and tried to remove as much of the emotion and look at it strategically and tactically and make those things. I also enjoyed what he had to say about Ring and how that went. And I think everybody in business has those situations where they've just been the right place at the right time and everything has gone well. And we've all had this situation where it's been the opposite. And I think the thing that makes AmFam Ventures stand out is that their batting average is really high. And if you look them up or you do some research on AmFam Ventures, you'll see that time and again they've been very successful. And you heard the number of acquisitions and exits, that successful exits that they've had. It's a high number. This is a group to watch, and I know it's a group that's emulated. It's very interesting also to hear that they're putting together a group of insurance companies to invest cooperatively in the InsureTech space, which is a great idea. You don't see that kind of cooperation typically among insurers, but on the venture side, you do. And that's something that we've heard before from other guests that we've had on in the venture space. There's a real cooperative spirit that exists among all these people. Anyways, I invite you to go online and to learn as much as you can about AmFam Ventures. They're very interesting, no matter what part of the InsureTech ecosystem you live in. They're a great story, and we thank Dan for being with us and for taking the time on the day before he goes on vacation, which was real generous of him. But I think it speaks to the kind of guy he is. So we thank you for being with us, and once again, we are not supported by any advertisements. So we ask that you support us by being a subscriber to our podcast, which you can do on any of your favorite podcast platforms, or you can go to fnoinsuretech.com. You can communicate with us there, as well as subscribe to our podcast from that address. So until next time, thanks for being with us. Goodbye, everybody.